Hello fellow investor, in this video I'm going to explain how to read this chart right here. This is the probability distribution used in option trading, but more in specific I'm going to explain how to use the Interactive Broker Probability Lab, which is a tool that Interactive Broker gives us for free if you want to trade option, and it helps us to understand what is the correct strategy we can do it. Don't worry if you don't have an account with Interactive Broker, because anyway they give you the possibility, even for non-user, you can check the link in the description, to use the Probability Lab for free. So if you just want to play around, you can do it without opening an Interactive Broker account. Let's stop talking and let's switch to the trader workstation. This is my dividend portfolio. At the moment the market is closed, so you don't see any movement. Let's go to open the Probability Lab. You can do clicking on new window, you go under option analysis, Probability Lab. And it opens this window. For the moment it's set up on Tesla. I think it's nice to analyze Tesla because it's one of the stock which is quite volatile, so we can understand a bit better how our option strategy works. And let's fix an expiry date for our option, the closest as possible. Today is 24th of July, so let's put the one on 28th. Let's start understanding the first part, the top part of this window, this chart right here. Let me make it bigger. Okay, so this is the probability distribution. Probability distribution tells us the probability that the stock price of Tesla will be in a certain range on 28th of July. How to read it is a chart on two axes. Let's start with the horizontal one. You see in white you have all the possible price that the stock can get from now up to 28th of July, which means from 222 up to 302. At the moment, the last close was, honestly, this is pre-market, I suppose, is 256. This, as you can see, is moving because we are in pre-market, so there are some movement, but it will not influence much our chart. So as I said, below there are the price, and in red you can see some percentage. This is the percentage. For example, how to read this? For example, you see on top of 222 there is 1.58 percentage. It means that there is 1.56% probability that the price of Tesla will be below 222 on the 28th of July. And so on. You can see it's cumulative. For example, if we go here to 245 with 17.32%, it means that there are 17.32% possibility that the price of Tesla will be below 245. As you can move on the right, you see the percentage increase because, as I say, it is cumulative, and you arrive to 302 that there are 98% possibility that the price is lower than that on the expire date. How they came up with this information, I will leave a link into the description with some detail, but basically this comes from the statistical analysis of the price of Tesla, how it moved in the history, how it's volatile, and so on. So this, of course, is just a forecast, doesn't mean that it will be exactly like that, but if you want to trade option, you need to understand the concept of the probability. Moving on the vertical side of the chart, we have the probability. This is the probability of each segment of this chart. For example, if we click right here, we see that the probability that the price of Tesla will be between 252 and 255, you will see down in yellow, is 6.19%. is written over there. So we can get the probability of each segment of this chart. Basically what this chart means, that the highest probability, 6.53% probability, is that the price will be between 258 and 260 on 28th of July. The chart is quite easy to understand. Now what we need to do with that, what we can do with this information. If you want to trade option, you need to have a thesis. You need to be bullish or you need to be bearish on a stock in order to decide how to trade option. Because, for example, if you are bullish, you will try to buy some call. If you are bearish, you will probably sell covered calls or stuff like that. Anyway, how to project your thesis on this chart? There is a simple way. For example, let's say we are a bit bullish about Tesla. We think that this probability is wrong. The probability is more moved on the right, so there are more probability that the price is increasing on 28th of July. You can click this arrow right here, and you see the charts start to change. It appears this red and blue part. From this you don't understand correctly, but if I move to the extreme, you will see this is completely two different charts. One is red, is your custom probability, and the blue one is the starting one we analyzed before. The overlapping part is purple. So this will be a crazy situation where you are extremely bullish, but is also out of sense mostly. But let's see something, let's say, reliable. You are a little bit bullish, like this on Tesla stock. You think that, even too much, you think that there is more possibility, you see more probable that the stock will be at a higher price on 28th of July. So after you project your idea, what you need to do with that? In this case, we need to go back to the previous window. You see, this is the same we analyzed, it's just compressed, but it's the same information. And now we ask the system to build a strategy, because this is what the Probability Lab does. You project your probability, which is different from the market, and you ask to build automatic strategy. The system, in this case, gives us three options. There are three different strategies. How to read this table right here. For example, let's select the first one. You see 268, 270 bull call. First of all, we need to see that the probability of profit with this strategy is 43%. It means we have 43% probability to make money using this strategy. And we will have a 35% probability to get the maximum return, which is $340. And 53% probability to get the maximum loss, which is $160. So what we need to understand here is that we invest $160 basically. We can return the maximum on 340 with a 35% chance, or we can lose it with 53% chances. Our break-even, the price under which we will start to lose, is 266.60. How it works, this strategy, we can see in this other panel. This is the order panel. I mean, if we submit the order, we automatically buy and sell the option according to this strategy. You see the strategy is divided in two legs. You need to buy a call at 265, which costs you 4.75, 4.80, let's use this number. And at the same time, you need to sell a call at 270, which give you in premium, because you are selling 3.30 or 330 if we want to think on already on 100 shares. So at the point, the cost for you is 1.60, 160, which is here the maximum loss. Here we are buying and selling calls, so our loss is fixed. We cannot lose more than that. So just to repeat, this strategy, 43% probability of profit, investment on 160, maximum return on 340. If we want to have a visual of this strategy to understand a little bit better, we go in this last segment, the strategy performance detail. I will try to show you bigger so you understand how it works. The chart is exactly the same we saw before. On the bottom part, horizontal part, you have the price of the stock. On the vertical one, on the vertical axis, you have the probability percentage. So this white line is your strategy. So if you are low in price, if the stock will close at this price, you see you have always a loss. You see it's down at this level that if you look on the right side, I will try to indicate when I will do some edit, is 160, your maximum loss. As soon as you arrive to 265, you will start to reduce the loss. You see on the right side how it goes up. You arrive to the break even, which is 266 we saw before. And from here you start to get money. And you have a cap, because you sold a call, to 340. So no matter where the price will go, your gain will be only 340. This chart, this type of chart is very popular, and you will see around a lot if you are into the option trading. Honestly, it can be a bit confusing, but if you play a bit with this probability lab, you will start to understand how things work. My suggestion is really to try to set up different option strategy. You don't need to make the order, but you need just to see how things are going. So let's go back. This can be a strategy. As I said, I can submit and I can have this one. But let's see the other one. For example, they give a strategy, for example, that are that have less probability to get a profit. For example, the second one is 32% probability. So we have less probability to get a profit, but we have also a lower maximum loss. For example, let's select it. Here you see you need to buy the call at 270, before was 265, and you sell the call at 275, before was 270. If we check on our performance, you see the previous one was now is in red, it's this thin line in red, and the new one is white. You see the loss at the beginning is lower. Before was 160, you see right here, 160, now is 113. So you are, let's say, betting less money, but you will start your gain after, not at 265, but 270. So of course there are less probability that the stock will go there, and so on. But you will be capped higher, so you can get up to 387 in total gain. So this is up to you. These are two different types of strategy. One is more risky, one is less risky, and it's up to you to decide. Trading option is not so far from gambling. Take this information as it is. I don't want to say that trading option is bad, but I want to say that it's more something of a trader than an investor. I said before in different video, or in general, you know, I am somebody who sell a lot of covered call on my dividend portfolio. This kind of option strategy is something else. And but it's something fun and people like a lot, especially stockbrokers like you to trade option, because they make money no matter what, because they have always their commission no matter which strategy you use, so they're very happy when you trade a lot. Another point I want to say, that all this probability right here, the profit probability, the probability of the maximum return or the maximum loss, can change according if we think about your forecast or the implied probability from the market. So the forecast, let's say, from Interactive Broker. If you move right here and you go to the market implied probability, you see that your percentage are a little bit lower. Why is lower? Is because you make some assumption here. We moved the chart on the right because we have an idea. We think this stock would be we are more bullish than, let's say, the market. So this is why we move it on the right, and this is the result. Pay attention, always double check the profit probability according your forecast and according the market. Because if your forecast move too far away, and we try to build a strategy like this, for example, you see your profit probability are much higher, but as soon as we move to market implied probability, it becomes very low. So pay attention to be too much bullish or bearish and move too far away from the market implied probability. So I hope it is clear how it works. This is just one example of type of, let me move back to a more normal situation. Let's rebuild the strategy, sorry. So this is just one example of what you can do, and we analyze only the bull call, which is the first type of strategy, that one of the most common type of strategy. But we can do also something different. I will show here briefly. Let's make this bigger. So as we said, let's move closer to the market implied probability. Let's try to make another type of option strategy. This is one I honestly like. So let's try to cut the 10%, the first 10% and the last 10%. For example, as you see, up to 240 you have 9.83% probability. So let's move from 240 up to 282. 282, which is 90% probability, it means the other part is 10%. So let's try to bet that the stock will be between 240 and 282. We have in this case around 80% probability that this will happen. Let's modify the strategy right here. So we say we buy a call at, sorry, we not buy, we sell a call at 282. So let's move it, 282. Okay, 282.5. And let's sell a put, in this case, at 240. Let's see, 240, here it is. This is called, you see before was called bull call, now it's called short strangle. This is another type of option, and it's the option where you bet that the result will be in a certain range. If you see right here, it's quite good for us because we are selling in both legs, so we get premium. In this case, we will get around $223, and you can see right here, our maximum return is 223, and we have 80% chance to do it. Of course, the maximum loss is infinity because the stock can go far up and far down. Technically, it can go to zero tomorrow or can go to 10,000, and really that will be quite a huge problem because you receive a margin call. But anyway, forget about this extreme situation. Also, I suggest to do this when you already own the stock, in order that these are cash secure put from one side or covered call from the other side. But this is an example. This is a quite nice option strategy. I hope the video was quite clear. Of course, I didn't enter into detail of all type of option trading strategy out there because there are really so much, and basically most of them I don't know myself. But let me know in the comment what you think, if you have any specific question, and I will maybe in future do some video more specific on some type of trading option strategy. Thank you for watching. As usual, if you don't do it, please subscribe to the channel because it really helps a lot, and see you to the next video.